Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap with me, Ryan Huang. We have stocks rebounding last night on Wall Street as investors stayed optimistic that the conflict between Israel and Iran may remain contained. And that saw a spike in oil prices due to the escalating conflict easing. And we have the Dow Jones Industrial Average up 0.8%, the S&P 500 advancing 0.9%, and the Nasdaq Composite surging 1.5%. And helping us to navigate what's to come in the next few days, we've got José Torres. He is the senior economist for Interactive Brokers. José, thanks for joining us on the show. How are you doing?
Good morning, Ryan. Good morning, Ajay. Great to be here. Doing great. How are y'all doing?
Well, doing as good as we can. Lots to digest and break down. And of course, I think we'll put the tensions in the Middle East front and center between Israel and Iran, where things are getting quite difficult to navigate because of all the moving parts right now. And there is a sense that it might spill over into a wider conflict. What are you observing right now? What are you taking away in terms of the levels of concern that are being afforded to this current situation?
Well, the fears were really quelled today. First, the conflict didn't spread to a wider war yet, and there is an expectation that that's not going to happen. Two, there's anecdotal evidence suggesting that Iran wants to talk with Washington, maybe talk with Tel Aviv and cool things off. And on Monday, we saw a huge plunge in the geopolitical premium. So gold bars and crude oil, that was reflected with sharp declines in both of those commodities. Meanwhile, stocks ramped up significantly, treasuries stuck in there, kind of flatlining, as well as the dollar. But overall, the Trump administration has really focused on subdued energy costs as a way to hedge the potential for goods reinflation. So if you did have an escalation further and further and oil prices stay above 85 for quite some time, that would drive the CPI to closer to 3% and deter the Fed from cutting at all this year.
Yeah, so right now we've got WTI at around 71, and it's down in the past 12 months by 10% plus. Brent is down by about 14%, trading at around $72 per barrel. All right, talk about a couple of implications. What is the potential, impact on the wider global economy if this continues to drag on?
Well, it would be lower growth and higher inflation. So that's would be a terrible situation. In the Middle East, that holds roughly a third of crude oil supplies on a global perspective. So oil is a critical commodity. If that spikes in price, it's very terrible for economies all around the world, particularly the most vulnerable ones. So we benefit from peace in the Middle East. That's what we need on a global perspective, so that economic prospects, which are quite uncertain right now, but for those growth numbers to really come through and be strong, we need peace in the Middle East and we need energy prices to be subdued. We can't afford a huge climb in the price of oil.
All right, let's take a look at what's coming up this week, and that's where we have the central banks in action, and we've got the FOMC, of course, we've got the BOJ. So that's going to mean, to some degree, they might be keeping an eye on what's playing out in the Middle East. Is there a sense that perhaps folks are becoming a bit complacent where things are right now?
I think investors are definitely pretty complacent, and it's benefited them to be complacent and to have the glass half full perspective. Now, central bankers, Ryan, on the other hand, I don't think they're complacent at all. In fact, I think that they're actually, in many cases, wait until inflation really comes down to their target, similar to what the ECB did, to begin accommodating more strongly. The Fed, we're going to see the summary of economic projections tomorrow. Market bulls want to see between 2 and 3 cuts projected this year. If the Fed only reflects one, that could be a source of volatility. And a reason why they may only put down one is because they're going to say, well, the geopolitical issues, this is similar to what happened in 2022. Russia invaded Ukraine. the price of oil went above $100, and then all of a sudden we had the CPI inflation in the U.S. at above 9%. So that's something, of course, the central bank here wants to avoid. So they're going to reference geopolitical uncertainty as well as trade unknowns and the impact of immigration and how that can potentially fuel price pressures in the labor market. It's already led to weaker labor supply here in the States. We depend a lot on immigrants as workers, namely in the agricultural, construction, leisure, and hospitality sectors.
Okay, so the Fed does have a dual mandate. So you've got inflation on one hand and you've got the economy on the other side, jobs in particular. So where are we right now in terms of that side of the equation?
So for a long time, I think that they're 70-30. And I think that they're 70-30 right now as well. I think that if you had an uptick in inflation, but the job situation weakened significantly, I think they would still cut. And then you can also get some QE maybe in the next 6 to 12 months if things deteriorate. I don't anticipate that. My outlook is still pretty positive. I think investors have also realized that from early April to now that growth is probably going to remain robust, but we need trade deals. We need peace in the Middle East. And we need the immigration deportations to not be as significant as expected.
Okay, I believe one of the parts they might be watching as well is how much consumers are spending, and that come in the form of the retail sales numbers coming through later this week. What are you expecting, especially off the back of the latest earnings season? Folks just reducing their forecasts or even withdrawing altogether. Where are we when it comes to spending?
Yeah, the consumer has been managing their budgets like a light switch. To the previous conversation that you and Anji are having, some months the consumers say yes to everything. But then the next month they see the credit card bills come in, they see some of those numbers begin to stagger. So they say, okay, I'm going to chill out this month and then go out next month. So I think for tomorrow morning, Ryan, in retail sale, that's a May report. We got 3 consecutive months of gains. The consensus expectation is expecting a decline of 0.7%. So it's probably not going to be a good report. But part of the reason why it's not necessarily terrible that it's not the best report is because consumers did a lot of front loading in February, March, and April. They bought a lot of physical products in anticipation of the Liberation Day tariffs. And this report tomorrow is heavily skewed to goods, not as much services. So we are expecting a big decline, but we've been seeing it with inflation, with high interest rates. Consumers, they go away one month, they come back the next. So I think that they're going to come back this month in June, and we'll get that report next month in July.
All right, talking about retail sales, we did get some of that in China in the past 24 hours. We saw a bit of a bounce there. Retail sales doing well, 6.4% up on the year, apparently helped partly by promotions of products stranded as shipments were suspended due to higher tariffs. What are you taking away from the numbers coming out from China?
Yeah, well, the policymakers in Beijing have really been trying to stimulate domestic consumption, and finally we got a huge number. This is the best number in roughly a year and a half since late 2023. So great news there. Still a lot of uncertainty. The other numbers in the report, industrial production, capital expenditures, those numbers weren't as good. The home price situation is still negative for the consumer and household psyche, but it's only down 3.5%. So, that's starting to stabilize for the Chinese, hopefully, and for Asian economies. Hopefully that becomes to turn around and go north, and then that'll really be a driver for growth in the next few years.
All right, talking about drivers of growth, we have been seeing the US dollar weakening to some extent. Where do you see things going for the greenback, and how much will that provide, I suppose, a tailwind for Asian economies?
Yeah, I think interest rates have to go lower. And because of that my outlook for the DXY is for it to hit roughly 94, 95. There's another 3 to 4% to the downside. And I think that's gonna support Asian economies. It's also helps President Trump's ambitions on the onshoring front and making those exports cheaper for foreign nations to buy from the U.S. So there's some focus there. Also, tech stocks. You mentioned earlier the Qs were up 1.5% today. Those revenues are denominated in so many different currencies. So a weaker dollar in the short to medium run is actually great for the Magnificent Seven earnings. Those are some of my views there.
Yeah. It's a great wrap-up of where things are going and what to expect, especially for the FOMC in the coming days. And we have been in conversation with José Torres. He's the senior economist for Interactive Brokers. Jose, thanks for the time and always great chatting with you.
Absolutely, Ryan. Thanks for having me. Looking forward to chatting soon.
Yep. Hope to catch you soon again. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.